Welcome back to Crypto Analysis Lab. If you're watching this, there's a very good chance you've already experienced something that most traders don't know how to explain. If you've ever been exactly right about the market's direction and yet you still found yourself losing money, this video is for you. What destroys most trading accounts isn't necessarily bad analysis, raw emotions, or even a lack of discipline. The real culprit is often the math of leverage, quietly working against you in the background, even when you think you're doing everything right. Leverage is typically sold to retail traders as a tool to accelerate growth and trade with less capital. While that is technically true, the industry rarely explains its most dangerous side effect. Leverage compresses your error tolerance. It shortens your time in the market and dramatically increases your mathematical probability of ruin. The market doesn't need extreme move to wipe you out. It only needs to move normally. Let's simplify this. When you use leverage, you're not just multiplying profits and losses. You are reducing the distance to liquidation, amplifying variance, and removing margin for randomness. For example, with 10x leverage, a 1% market move becomes a 10% account move. That doesn't sound dangerous at first, but markets don't move in clean straight lines. They fluctuate, they weak, they hunt liquidity, they spike on low volume. And leverage does not care about your analysis. It only cares about math. This is where most traders get confused. They say, I was right about direction. I had a good setup. My analysis made sense. And they're often telling the truth. But trading is not about being right. It's about surviving being slightly wrong. Even the best strategies have losing streaks, drawdowns, periods of underperformance. That's normal. What's not normal is trying to survive those periods with high leverage. Leverage accelerates variance, and variance is what kills accounts, not bad ideas. Every trading system, no matter how good, has a distribution of outcomes. That includes consecutive losses, unexpected volatility, unfavorable sequencing. Professional traders design for this. Retail traders deny it. They size positions as if losses should be rare, drawdowns are personal failures, and every trade must work. Leverage doesn't forgive that mindset. It punishes it. You don't blow an account because you're wrong once. You blow it because you can't survive a normal losing streak. Here's something most people don't want to hear. If leverage was the solution, the most leveraged traders would be the most successful. But reality shows the opposite. The traders who survive long-term use lower leverage, risk less per trade, accept slower growth, and protect their capital aggressively. Why? Because probability only works over time, and leverage shortens time. Professionals don't ask, how much can I make on this trade? They ask, how much can I lose and still stay in the game? Their focus is survival first, consistency second, returns last. They understand that leverage is optional, survival is not. Your job as a trader is not to maximize returns. Your job is to minimize the chance of ruin. Everything else comes later. Leverage is not evil, but without structure, without risk engineering, without respect for variance, it is unforgiving. If this video made you rethink how you size risk, that's a good sign. It means you're starting to think like a professional, not a gambler. If you want to see how all of this fits into a complete learning structure from market reality to execution systems. You can explore the full program at cryptoanalysislab.com. In the next video, we'll talk about another reason why most traders still blow accounts even with good analysis, and why structure matters more than insight.